Welcome back to SR Money News, where we analyze structural shifts across global macro landscapes and domestic enterprise equities. Today, we conduct a deep portfolio insulation assessment across 6 critical market drivers shaping modern capital rotation. From high-conviction infrastructure execution in Rail Vikas Nigam Limited, ticker RVNL, to software modernization and artificial intelligence scaling at Tata Consultancy Services, ticker TCS, institutional money is actively recalibrating risk models. Concurrently, regulatory resolutions surrounding the Adani Group offer governance clarity, while precious metals like gold and silver provide essential tail risk hedging. Think of the current Indian equity market as a multi-lane highway, while cyclical growth stocks act as high-speed passenger vehicles driving short-term performance. Core state-owned enterprises and Bullion act as heavy-duty transport vehicles providing momentum and structural balance against unforeseen economic potholes. To navigate this dynamic, sophisticated investors must evaluate core moats, capital expenditure pipelines, and operating efficiency. Over the next 10 minutes, we will systematically dissect quarterly earnings performance, management commentary, regulatory evolutions, and forward guidance to establish a resilient multi-year framework for long-term capital preservation and growth. Focusing first on Rail Vikas Nigam Limited, or RVNL, the Q1 financial performance reveals critical insights into public sector execution and order book realization. RVNL recorded steady year-over-year revenue expansion, driven primarily by accelerated project completion in major railway electrification and metro corridors. Operating margins demonstrated resilience, reflecting disciplined input cost management despite supply chain pressures. To understand margin expansion in an engineering and construction firm, imagine a toll booth operator who not only collects fees for more cars passing through, but also automates the lanes to reduce operating costs per vehicle. That dual efficiency is what widens the gap between gross revenues and net operating profit. RVNL's order book remains robust, exceeding multi-year trailing revenue benchmarks, which provides high earnings visibility. However, working capital cycles warrant close monitoring, as delays in milestone payments can occasionally press operational cash flows. Institutional analysts view RVNL's disciplined execution as a benchmark for state-owned infrastructure assets, illustrating how sovereign-backed capital deployment creates a strong competitive moat against balance sheet contagion in volatile macro cycles. Shifting to the technology landscape, Tata Consultancy Services, or TCS, presented forward-looking management commentary during their latest earnings interaction, highlighting enterprise artificial intelligence deployment as a primary growth vector. TCS is aggressively training its workforce in generative AI frameworks and embedding automated capabilities directly into core cloud transformation projects. In simple terms, think of TCS's enterprise AI integration like installing advanced turbochargers into an airline's existing jet engines. Rather than building entirely new airplanes from scratch, they are making the existing fleet run significantly faster and far more fuel efficiently for enterprise clients. Management reported a growing total contract value pipeline, specifically led by cloud migration and cost optimization deals across North America and Europe. While traditional IT spend faces temporary discretionary delays, long-term multi-year digital transformation contracts remain sticky. TCS's ability to maintain industry-leading operating margins while absorbing headcount training investments demonstrates immense capital allocation flexibility. Institutional investors view this proactive AI upskilling as a structural moat, positioning TCS to capture high-margin IT spending as enterprise digital budgets expand over the coming quarters. Moving into corporate governance and legal developments, reports indicating the closure of the United States regulatory probe into Adani Group entities mark a pivotal risk-de-risking event for foreign portfolio investors. The resolution clears significant governance uncertainty that previously applied a valuation discount across group equity counters including Adani Enterprises. To visualize this institutional de-risking, imagine a cargo ship navigating through dense fog with reduced speed. Once the fog clears and full regulatory clearance is signaled, the captain can safely increase throttle speed and optimize trade routes. The removal of legal overhangs directly facilitates institutional capital re-entry and lowers international debt refinancing costs. Adani's capital allocation model, centered around core ports, power generation, and green energy infrastructure, requires continuous debt capital markets access. With legal clarity restored, global credit rating agencies and infrastructure funds are reevaluating risk premiums. This structural milestone highlights how balance sheet resilience and formal legal closure work together to restore corporate valuation multiples and reignite foreign institutional investment flows into critical domestic infrastructure projects. Broadening our macro lens to global commodities, precious metals like gold and silver are experiencing sustained structural demand driven by sovereign central bank reserve diversification and systemic inflation expectations. Gold serves as a premier risk-off collateral asset, while silver benefits from a dual identity, a store of value and an indispensable industrial input for solar photovoltaic cells and electric vehicle electronics. Think of precious metals in a modern asset allocation strategy as buying home insurance for a luxury property. You do not purchase insurance hoping the house burns down, but rather to protect your total net worth against rare, devastating macroeconomic fires. As major central banks navigate monetary policy easing and global trade realignments, physical bullion assets provide essential portfolio insulation against currency debasement. Institutional asset allocators are increasingly utilizing sovereign gold ETFs and physical bullion funds, such as gold Bs and silver Bs, to rebalance portfolios. This persistent bid under bullion underpins structural support across global commodities, offering non-correlated defensive performance during periods of equity market volatility and foreign exchange fluctuation. Despite encouraging macro momentum, prudent portfolio risk management requires analyzing active regulatory and geopolitical headwinds. In the domestic consumer market, strict enforcement actions by bodies like FSSAI, driven by administrative leaders like IAS Tukaram Mund, highlight heightened regulatory compliance scrutiny across food safety and consumer goods supply chains. For corporate entities in the FMCG sector, such as Tata Consumer Products, non-compliance or supply chain lapses can trigger sudden operational halts and brand equity impairment. Metaphorically, regulatory enforcement acts like strict traffic cameras on a high-speed highway. While established, compliant companies can maintain speed seamlessly. Those cutting operational corners face immediate, costly penalty tickets. Internationally, geopolitical developments such as trade policy shifts under a prospective Trump administration introduce cross-border tariff risk and foreign capital flight volatility. High input cost inflation, regulatory compliance costs, and global currency swings represent tangible downside risks that could compress corporate operating margins. Investors must continuously stress test portfolio companies against regulatory tightening and macroeconomic policy shifts to prevent capital erosion. Synthesizing these multidimensional factors, the forward-looking market outlook demands a disciplined balance between cyclical growth exposure and defensive risk management. Structural capital spending in Indian infrastructure, spearheaded by public sector enterprises like RVNL, provides a reliable multi-year earnings floor. Simultaneously, high-margin enterprise digital modernizations led by tech leaders like TCS present medium-term valuation expansion opportunities as global spending recovers. Corporate governance clearances in large conglomerates like Adani restore market confidence and unlock lower-cost international borrowing. Meanwhile, maintaining dynamic portfolio exposure to gold and silver guarantees resilience against potential geopolitical shocks and fiat currency volatility. Think of this multi-asset investment strategy as maintaining a perfectly balanced nutritional diet. Infrastructure and tech equities provide muscle growth and capital appreciation, while precious metals and regulatory-compliant consumer stocks act as essential vitamins protecting the system against unexpected illness. By regularly assessing cash flow durability, order execution rates, and debt service metrics, institutional investors can systematically capture alpha while insulating core capital against broader macroeconomic headwinds. In summary, surviving and thriving in evolving financial markets requires moving beyond short-term retail noise and executing structured, institutional-grade risk assessment. Whether analyzing order book execution in railway infrastructure, tracking software modernization cycles, monitoring regulatory clearances, or hedging via precious metals, risk discipline remains paramount. At SR Money News, our commitment is to provide clear, actionable, and non-hyped financial intelligence designed for sophisticated market participants. If you found this strategic breakdown valuable, please hit the like button, share this analysis with fellow investors, and subscribe to SR Money News for continuous institutional coverage. Turn on notifications to never miss our timely earnings breakdowns and deep macro intelligence reports. We want to hear your perspective. How are you balancing core infrastructure stocks against gold hedges in your long-term portfolio? Share your thoughts in the comments section below. Thank you for watching SR Money News. Maintain your process, manage your risk rigorously, and we will see you in our next institutional market update.